Hi, I'm Kalei Cadinha-Pua'a, and I have Harlan Cadinha, our Chief Strategist and Chief Investment Officer. With all the volatility in the markets, Harlan, I thought this would be a really good time for us to sit down and kind of tackle some questions and hopefully address some of the concerns that we're beginning to hear from some of our clients that may be on the minds of other clients. So today we're going to be tackling kind of three main issues. One is the debt ceiling, and give you kind of our outlook on what we see with that. The second is the banking industry crisis. We're still receiving some questions about banks and what we forecast for the industry going forward. And the third is whether or not, we're in a recessionary time or if we actually have economic growth. So before we launch into those three areas, could you just give us kind of a market outlook and some of the things that we're watching as a committee?
Well, as you know, we've been conservative for over a year, not liking the fundamentals. And anytime the Federal Reserve Board is chasing something like inflation, the time lag till you finally get the results you're looking for can be very long. And I think that's part of the problem. So the Fed has been raising rates sharply and quickly to try to get to inflation. And inflation is responding, it's coming down. But the problem or the issue is how long is it going to be until we hit that 2% objective? The Federal Reserve has said they want 2% on inflation. So while we're trying to get there, the money supply is dwindling. The money in the banking system is dwindling. Credit is dwindling. And the question is the trip going to take too long so that we finally torpedo the economy into deflation or something bad like the 1930s or just a bad recession? We don't see any of that yet, but we see the precursor to that, and that's why we're cautious about the market.
I know money supply, M2, came out for the 9th month in a row lower, and it's actually hitting some pretty historical lows. Can you talk a little bit about money supply and what our current levels are signaling to us and what's causing concern on the committee side?
Well, money makes the economy work. And money supply and the banking system is where money's facilitated into the economy. And it moves, and people borrow money, and they build factories, they build houses, and those are all economic circumstances. But with the supply of money actually shrinking, and this is because of the Federal Reserve Board, it's very hard to imagine in the future an economy that's going to grow on a shrinking money supply. They don't go together. So what seems to go together, has always worked this way, is that we expect a slowdown in the economy because money supply is just shrinking. And when you look at money supply over time, 9 months, 1 year, it has not dropped to the level that it's dropped or slowed to the level that it is since 1934. So we're in a serious M2, which is an aggregate for the money supply. We're in a serious decline. And that kind of spooks us.
Right. Just to give you all some perspective on the degree to which money supply has slowed, money supply 2 years ago was up, I think, over 18%. Even a year ago, up over 7.6%. So the most recent mark of being a negative 4.6%, like Harlan said, is the greatest contraction in money supply since the 1930s. So, again, to echo what Harlan's saying, extreme concern, and we're watching it very closely. I'd like to jump into kind of the most pressing question that we've been receiving, and it's all evolving around the debt ceiling. I think it's really important for our clients to understand kind of what is at stake with the debt ceiling and explain to clients default, because some of what we're hearing, quite honestly, is a lack of understanding of the vocabulary that follows the debt ceiling. So can you explain what a default is?
Well, first of all, the debt ceiling is something that Congress has to allow. They have to allow the government to borrow. So we have a cap on banging up against that limit right now. But this has nothing to do with the money supply coming down that we were just referring to. Okay, this is government looking forward. And when they say default, what that really means is that government will default on its debt or its interest payments on that debt. And that's very different than whether government's going to pay for student lunches this year or going to donate money to retirement plans for military that retires, or some of these other obligations. They're obligations of the federal government, but the Constitution is very definitive on debt default. Okay, now insofar as that's concerned, I really don't think we have a problem. In a technical sense, the United States is collecting tax revenues. We collect more revenues than we have expenses. So we have a lot of money to pay the debt service, to pay debt that's expiring. We may have to pass on some other obligations, some other budgetary obligations, but we have enough money to pay the debt. So to us, the best alternative for cash is the U.S. government treasury bill or treasury bonds or treasury notes. These are the debt obligations that must be paid, and we have money to pay them. So the rest of it is politics, but I see the market getting very afraid of something not going to be able to pay off or pay its interest, and the market's getting spooked and whatnot. We're nailed down in treasuries, U.S. treasury bills and treasury obligations, so we're trying to avoid money markets and mutual funds that pay interest, et cetera, et cetera. Those aggregated funds could be a problem if people panic, but you don't have to worry about treasury bills at all. We think it's safe, and we think there's adequate money to cover it.
And really, with the confusion in the market and people growing more and more concerned about the debt ceiling, some of the bond yields, especially on the short term side, are rising. So cash and cash equivalents, the shortest part of the U.S. Treasury curve, is yielding over 5.5%. Auctions are coming in even higher than that, and so it really benefits our clients for us to pick up these instruments that, in our opinion, are very safe. It remains safe. Our obligations of our government constitutionally must be paid first before other obligations at higher rates of return. So it's beneficial as these rates rise for us to pick up some of that and keep the quality very high in client portfolios. With that said, another question that we're receiving from clients still is around the banking industry crisis. After Silicon Valley Bank closed and Credit Suisse closed, clients are still concerned with the quality of banks. Can we address kind of the current credit crunch and what's transpiring in the banking industry?
Well, banks are getting squeezed. It's as simple as that. Banks are like any of us. They're run by human beings, and when you have a contraction in money supply, the value of the instruments that go into money supply come down, right? So the banks are sitting on portfolios of bonds and mortgages and other loans that they've made, and the value of these loans are coming down because the credit is getting tighter. So there's no way to know whether a bank's really in good shape or in really bad shape until things happen and you get bank records and you take a hard look. I mean, I took one of our local banks home for the weekend and looked at all of the finances of the bank, all of the reports and everything else. and bankers are doing what they can do to stretch this or that and make it look good on the outside. But the risk is still high for an undercapitalized bank. So just because Silicon Valley Bank is over doesn't mean this is over. This bank issue is still around, right? And another bank can make a poor judgment and all of a sudden find themselves in the ditch. And then we read about it, and then you got another bank run. So it's not over. And as long as you have this shrinking money supply, you know, it's in trouble. And I might add, just for yourselves to look at, you know, we try to invest along themes. And we picked one. Our top theme has been artificial intelligence, because we feel there's going to be a lot of money spent on AI, and the chances of the companies that are leading that charge of making more money is great. So we chose Microsoft, NVIDIA, and Apple as our stake along that theme. Today, NVIDIA came out with earnings that blew off the charts, and the stock was up 26% for a day. So you're starting to see that kind of growth. But when you pick themes, you know, you want to pick a theme that's going to be there, regardless of the economic circumstances. We feel money's going to be spent in AI, because the general market buying any stock without a good theme that you can see, that like a wave that it can ride, doesn't look that promising, because of what we talked about, diminishing money supply, and the economic growth at large is really questionable going forward. You know, do we have a recession now? Don't know. But it's time to be careful, and it's time to also keep a watchful eye on themes and players in those themes, because that's where the money can be made. But that's our word for today. We just wanted to bring everybody on board as to what this debt ceiling business really was all about. And I don't think it's a lot to really worry about, especially if you're owning U.S. Treasury paper. You know, just let the politicians play their games, and I think it'll come out. And insofar as the economy, investing, caution until we can see the end of this Federal Reserve game of diminishing money. Anyway, thanks very much. We'll be in touch.
Thank you.